Well, good morning, everyone. This is Kelly Moore with More Benefits, and I've invited Caitlin Goodell, who is an ERISA attorney, to help us understand more about the Affordable Care Act and the employer responsibilities that apply to us now. Caitlin has been doing these for quite a while, and I've been on some of her webinars, and she gives some pretty good information as well as examples that hopefully you can relate to. I would ask if you could put in any questions you have as they come up, and I'll watch them, and towards the end, if your questions haven't been answered, hopefully we'll have some time to get those questions answered. If not, and if you want to talk in more in depth, you can email me, or also you can email Caitlin directly. So with that, I'd like to turn it over to you, Caitlin.
All right, thanks. Like Kelly mentioned, my name is Caitlin. I'm an attorney out of Minneapolis, Minnesota, and work for the firm Seton Peters and Revenue. And our firm practices exclusively representing employers in basically all aspects of any type of labor and employment law. We have a nationwide practice, and we represent every type of industry, every size employer, and we have seen and heard pretty much any issue that comes up with employers. I specifically work on a day-to-day basis in the benefits area. I do a lot with ERISA. I do a lot with the Affordable Care Act, setting up benefit plans, answering questions about how to apply benefits, how do we set up our plans, how do we get our plans in compliance, and what to do with all of these new Affordable Care Act rules. I also want to quickly mention we do have two more webinars coming up. Today, as you can see, we're focusing on sort of the overview of the employer responsibility section of the Affordable Care Act. And then on Wednesday, June 10th, we will be talking about accounting for variable employees. Basically, we will be focusing on the look-back measurement method. That webinar is geared towards those large employers who are using or want to use the look-back measurement method. So keep an eye out for that. And then again, on Wednesday, June 24th, we are going to be talking about the new IRS reporting requirements. This is a really important webinar to attend because these are brand new requirements. They are for employers with 50 or more full-time plus full-time equivalents. There's a lot of information you need to be gathering now and that you will need to report about at the end of the year. And so it's important to get a head start on that. And so again, that last one is June 24th. I will do my best to keep us on time, keep us on schedule. With that being said, there may or may not be time for questions at the end, but if you do have questions, I'm happy to answer them in writing via email, either email me or email Kelly. Additionally, we will send out a copy of the PowerPoint slides at the end of the presentation as well, so you can have those to refer to. So let's do just sort of a brief introduction into the Affordable Care Act. I like to start with this because it is called a million different things. It's called the Patient Protection and Affordable Care Act, the Affordable Care Act, Healthcare Reform, Obamacare, President Obama's Healthcare Law. I generally refer to it as the Affordable Care Act or the Patient Protection Affordable Care Act, abbreviated ACA, PPACA, just that's what the name is on the actual law, and so that's what I go with. Most of you are probably familiar about sort of the history, but just, you know, sort of the things that have been going on more recently are important. There is a Supreme Court case that was argued on March 4th of this year. It was the King v. Burwell case. We are still waiting a decision on that, but this is important and can impact employers. A sort of nutshell what is going on with that, and we'll talk a little bit more about some of these things as we go through the presentation. But basically, in the King v. Burwell case, there are premium tax credits available for individuals through exchanges. And the actual text of the law says that the premium tax credit is available through exchanges established by the state. And the entire case is based on those 4 words, established by the state. 16 states have their own state exchanges. Those states do include California and Minnesota, which I believe most of us are located in, either California or Minnesota. And so it will not impact us as much. However, for all those states, if you have employees in other states or if you are located in other states, the federal government set up the exchange in the rest of the states. And That being said, the IRS wrote this rule that the premium tax credit was available through both the state exchange and the federal exchange. This rule was challenged, and so now the Supreme Court is going to decide if they are going to take a literal interpretation of those 4 words, that the tax credit is only available through an exchange established by the state, or if they're going to take a more broader conceptual approach of like, oh, well, no, they really meant to say, you know, the premium tax credits are available through any exchange. And so as we go through the presentation and we talk a little bit about the premium tax credits and how those can trigger penalties for employers, keep in mind that if your employees cannot get a premium tax credit because they are located in a state with a federal exchange, based on what the Supreme Court decides, those employees may not be able to trigger a penalty for employers. Like I mentioned, we'll talk about that more later on. A couple of other things to note. The Affordable Care Act adds rules to the Internal Revenue Code, the Fair Labor Standards Act, ERISA. It is enforced by the IRS, by the Department of Labor, by the Department of Health and Human Services. So it is a very broad-ranging, far-reaching, multiple agencies, interconnected law and rule, which basically makes it so complicated. Now, what are we really focusing on today? We are focusing on the one rule that really impacts employers the most, and that's the employer mandate, or the requirement that large employers offer coverage to their full-time employees and their dependents that is affordable, that offers minimum essential coverage, that offers minimum value, and if employers do not do that, they will be assessed a penalty, either for not offering coverage or offering coverage that is not affordable or doesn't offer minimum value, etc. When we are talking about large employers, we are talking about applicable large employers, sometimes abbreviated as an ALE. These applicable large employers are technically defined as 50 or more full-time plus full-time equivalent employees. I understand, and we will talk about that there are some rules for 2015. That means certain medium-sized employers are not going to be penalized in 2015 for not offering coverage, but the technical official definition of applicable large employer is still 50 or more full-time plus full-time equivalent, and that becomes really important. We'll talk about this in this third webinar when we talk about the reporting requirements, because all large employers are required to report. Definition of large employer is still 50 or more. Therefore, employers with 50 or more full-time plus full-time equivalent employees have to do the new IRS reporting requirements, even though some of those employers will not be assessed any type of penalty in 2015 for not offering coverage. We'll continue to dive into these definitions a lot. It is very important to understand all of these different definitions and keep them all straight. But let's go ahead and jump right into how do we determine if you are a large employer. It is so important that you know your size, so important. For one, for employer mandate reasons, as we'll see, there are penalties if you are a large employer and you're not offering your employees coverage. If you're a large employer, you have additional reporting requirements that have additional penalties that apply if you do not do the reporting requirements. In addition to knowing your size, you really need to know how to calculate your size correctly. I am still dealing with employers on a day-to-day basis that have calculated their size incorrectly and are actually large employers. They thought they were small, turns out they're not, and should have been offering coverage as of January 1, 2015. They're going to have to basically suck it up and pay the penalty for the first half of the year, and we're scrambling it around now trying to get them coverage, get their employees coverage, so they don't have additional penalties for the second half of the year. Employers are still sort of struggling in how to figure out their size, making sure that they have all of the correct information. And so I have broken it down into a step-by-step how to determine your size. Before that, let's just talk a little bit more again, sort of reiterate the definition of full-time employee. That's 50 or more. That's the magic number for the definition of full-time employee. However, there is a transition relief for those medium-sized employers. You do not have a penalty in 2015 if you had 99 or fewer full-time plus full-time equivalent employees during 2014. Why do we care about the number of employees in 2014? Well, because when you determine your size, you use the previous calendar year's employee count. In this first year for 2015, you can use 6 consecutive months in 2014 as chosen by you, the employer. You can use any 6 consecutive months in 2014 to determine your size for 2015. After that, you have to use the entire calendar year. So when you are determining your size for 2016, you will use every single calendar month in 2015 to determine your size. Once you figure out your size based on every single calendar month in 2015, you will be locked into that size for all of 2016. I get questions a lot on, oh, what happens if I was over the 50 mark or over the 100 mark for the first half of 2015, but then we had a huge reduction in force, we got rid of a ton of employees, and now I'm under 50. Do I still have to continue offering coverage? Well, the answer is yes, because you are locked into your size for your entire year. Your reduction in force in 2015 may impact your size for 2016, but once you have determined your size, that is your size for the entire year. When we talk about how to calculate your size, we're going to talk about an hour of service. And as many of you know, as I hope all of you know, the Affordable Care Act defines a full-time employee a little bit differently than the rest of us had traditionally defined full-time employee. For Affordable Care Act purposes, a full-time employee is one who works 30 hours a week or 130 hours a month. And when we say 30 hours a week or they work 130 hours a month, we're talking about hours of service. It can get a little bit more complicated than just hours worked because the definition of hours of service includes each hour for which an employee is paid, but also each hour for which an employee is entitled to payment due to things like vacation, holidays, illness, layoff, jury duty, military duty, etc., etc., etc. This provides or results in some problems for employers that have a lot of volunteers, especially volunteer firefighters. For employers with student employees, if there are any educational employers who have adjunct faculty, employers in the airline business where their employees have layover hours or on-call hours for those in the medical field. There are special rules for a lot of different types of employees, but in general, the hour of service is going to be each hour for which an employee is paid or entitled to payment. Except you don't have to count an hour of service when you pay an employee for unemployment compensation or workers' compensation. That does not count as an hour of service. But other types of paid leave, other types of paid jury duty, paid FMLA, things like that, can count as an hour of service. So it's not necessarily just every single hour your employee is at work actually working. You really have to sort of dive into that hours of service and take a look at your whole workforce and see who's on leave, who's being paid, who's not being paid, are they being paid for workers' comp reasons, or things like that. So now that we have a good idea of sort of our goal numbers we're looking for here, and we all understand an hour of service, let's look at the step-by-step way to actually determine your size. Step 1 is to calculate the number of full-time employees, 130 hours of service in a month, for each month during the previous calendar year. So if you're going to do this to determine your size for 2015, you will start with January 2014. Say, great, how many of my employees had 130 hours of service in January 2014? then you'll move on to February, then March, then April, then May, et cetera, throughout the entire calendar year. Unless you want to take advantage of that short rule for 2014 and you want to use any 6 consecutive months in 2014. Otherwise, you use the entire calendar year and you first calculate the number of full-time employees for each calendar month. Then you go back and for each calendar month, you calculate the number of full-time employee equivalents you have, abbreviated as FTE. Do not forget about your FTEs. They are very important. They can add a lot of numbers to your size. A lot of employers think, well, yeah, no, I totally have under 50 full-time employees. I only have 20 full-time employees. And then they have 75 full-time employee equivalents, and that pushes them over the 50 mark or maybe over the 100 mark. You can't forget about your full-time employee equivalents, your FTEs. To calculate the number of FTEs you have for each calendar month, you need to determine all of the hours of service in the calendar month for all the employees who are not full-time. So every single part-time, seasonal, any temporary employee, all other employees that are not full-time, you determine how many hours of service they have total, all added together for the calendar month. However, you don't include more than 120 hours of service in 1 month for one employee. So if an employee works 125 hours of service in a month, they're not full-time because they haven't hit that 130 mark, but you only add in 120 hours to determine the FTE status. So you get a little break for those employees working between 120 and 130 hours of service in a month. So once you have figured out your aggregate numbers, aggregate hours of service for all your part-timers, seasonal employees, all your other non-full-time employees, you divide that total number by 120, and the result is the number of FTEs you have for that month. And so in general, each part-time employee is going to be a fraction of a full-time employee, and it's going to be comparable to how many hours they work. If they work exactly half the amount of hours as a full-time employee, they will be 0.5 of an FTE. But the more hours they work, the more towards a full-time employee that will count, the higher the FTE count, etc. So you have to go back and do that for every single calendar month. So you will have a full-time employee count and a full-time employee equivalent count for every calendar month. After that, you're going to add together the number of full-time employees and the number of FTEs for each calendar month in the year. Then you average it out. So you add up all your monthly totals and then you divide by 12. That is your average number of full-time employees for the calendar year. You cannot forget about the FTEs. That's where so many people go wrong, as they forget to add in the FTEs. Do not forget about them. There are a few other additional rules that come into play when you're determining your size. If you have seasonal employees, you might be able to take advantage of the seasonal worker exception. You might. In general, seasonal workers, seasonal employees have to be counted in your full-time calculations. If you hire these workers just during the holiday season, they are still going to count towards your full-time and full-time equivalent numbers unless the employees in excess of 50 or 100 are seasonal employees. We'll get to that a little bit in the second slide. But how do we determine who's a seasonal worker? A seasonal worker is someone who performs labor on a seasonal basis. Basically, the best example is retail workers during the holiday season. They're hired just for the holiday season. There is no hard and fast definition and rule for this. Basically, employers should be applying a reasonable good faith interpretation of the term seasonal. I would look at how you advertise the position, what you tell the employee when they're hired, Is this something that's going to be ongoing? Did you tell the employee that? Did you advertise it as a full-time regular job? Then it's probably not a seasonal position. One other thing to note, because all of these rules do not get confusing enough, this one is specifically called the seasonal worker exception. It is not to be confused with the seasonal employee definition in the look-back measurement method. We will touch on that during our second webinar on June 10th, but there are two separate seasonal employee rules. One is the seasonal worker exception for determining your size, and one is the seasonal employee definition that helps you apply the look-back measurement method. They are different. So the seasonal worker exception is if you have more than 50 or 100 full-time plus full-time employee equivalents for less than 120 days in the calendar year, and basically those employees that push you over 50 or push you over 100 for 2015 are the seasonal employees, you can disregard those seasonal employees. And you will not be considered a large employer. However, if your seasonal employees push you over 150, doesn't matter. You have to include them all. If your seasonal employees are employed for more than 120 days in a calendar year, and therefore you have over 50 or over 100 full-time plus full-time equivalents for more than 120 days in the calendar year, you have to include them all and you're going to be a large employer. Which is why I say you might be able to take advantage of the seasonal worker exception. You might. Some employers are able to. Some employers have a longer season. Some employers hire seasonal employees for 6 months of the year. Some employers hire them for 7 or 8 or 9 and call them seasonal employees, but they're really not. And so just because you hire seasonal workers, just because you call them seasonal, does not mean you will be able to take advantage of this. So you need to look really closely at your workforce, your size, and how you label your employees to see if your seasonal matches up with this seasonal definition, and if that actually does help you stay under that 50 or 100 mark for full-time plus full-time employee equivalents and keeps you under the large employer size. If it doesn't, then there's no point in using it. It's not helpful to you or anyone else, and so don't even bother. It's going to depend on your workforce size, and it's going to depend on what you consider seasonal. Now, I keep mentioning that 50 or 100 because there is that break for what I call medium-sized employers. Now, technically, I keep saying technically, officially, the definition of full-time or the definition of a large employer is 50 or more full-time plus full-time employee equivalents. However, for this first year, for 2015, there is no penalty for these medium-sized employers as long as you meet certain eligibility conditions. What does this mean? This means basically employers between 50 and 99 full-time plus full-time equivalents will not face a penalty for not offering coverage in 2015. However, those employers with between 50 and 99 full-time plus full-time employee equivalents, they do have to certify on the new IRS forms that the employer met all of these eligibility conditions, that it really is the size that it says it is, and that's part of the new IRS reporting requirements, which we will be talking about in the third webinar on June 24th. And so it's very important that you understand that the penalty for offering coverage is different than your requirements for reporting to the IRS. Just because you don't face a penalty in 2015 does not mean you don't report to the IRS. So how do you know if you meet these eligibility conditions for the medium-sized employers? They sound complicated, but they are not actually as complicated and don't actually impact as many people as it looks. But basically, in order to have no penalty in 2015, you have to be between 50 and 99 full-time plus full-time employee equivalents on business days during the 2014. You cannot fire a bunch of people to meet these size requirements. You basically have to keep about the same size you've been for a while. You couldn't have been familiar with the rule and been like, great, right before 2015 starts or maybe in the middle of 2014, we're just going to fire half our staff and we're going to be a medium-sized employer. That's not going to work out. IRS is on to you, understands what you're doing. So if you did have a big reduction force or you did have to terminate a large number of employees, you better have a good bona fide business reason to do that. You have documentation showing, yep, our production is down, our revenue is down, we had to terminate. Then that's fine. The IRS realizes that for business reasons, sometimes you do have to have a reduction in force, but you better have good documentation of that if you did terminate a lot of employees in 2014 and now you meet the medium-sized employer requirements. You have to basically maintain your previously offered health coverage if you offered coverage in the past. And so you can't take advantage of this one-year break and say, great, we've traditionally offered coverage to all our employees, but nope, not anymore. We're going to take a break for a year. We're going to save up a ton of money because we know in 2016 we're going to have to offer everyone coverage again. So if you traditionally offered coverage to your employees, you have to continue to offer coverage to those employees. You can't narrow down the eligibility conditions. You have to continue to contribute about the same amount for the employer contributions, which is at least 95% of the dollar amount you contributed basically in 2014, or contribute the same cost percentage to the employee's plan. And if you change benefits under the plan, you have to make sure your new plan offers minimum value. These are all things you're going to have to certify to the IRS, and so make sure you understand and you have gone through and just check these off and make sure that you did continue to offer coverage. You didn't materially reduce your health coverage by basically withdrawing employer contributions or offering a very, very low. I don't even know that there are many plans that don't offer minimum value, so that's not a huge problem. But I would just go back and check. If you are taking advantage of the medium-sized employer 1 year reprieve from the penalty, I would just double check that you meet all these conditions. You probably do. I haven't had any trouble from any of the employers I work with. Like I said, the conditions appear to be more strict than they actually are, but you're going to want to double check because you do have to report it to the IRS. Now, there's another part that comes into play when we talk about, are you a large employer? And being part of a controlled group can impact your size as well. So in certain circumstances, all employees of commonly controlled corporations are treated as employees of a single corporation. And so there are three basic types of controlled groups. The parent subsidiary is basically the parent corporation. Parent corporation A owns 100% of subsidiary corporation B. So they have a parent subsidiary controlled group. All employees of corporation A and corporation B are added together to determine if the group as a whole is a large employer. There are brother-sister controlled groups. This is when 5 or fewer common owners, which are individuals, estates, or trusts, own a majority of stock in each corporation and own a majority of identical stock in each corporation. This brother-sister controlled group gets very confusing to explain out loud. It is something that is easier done on paper and explained that way, and it's not really worth your time or my time for me to go through it. But know that if you have 5 or fewer common owners and they own multiple businesses, you're going to want to ask someone to do a controlled group test to see if you are part of a controlled group. Because again, if you're a part of a controlled group, all employees from all corporations, members, businesses in the controlled group are added together to determine if the group as a whole is a large employer. You can also have a combined group, which is basically when a chain of corporations are connected through a variety of parent-subsidiary relationships, brother-sister relationships. Think of sort of like a big family tree and everyone's related and intertwined. That's what happens when you get a big combined group of corporations, businesses, etc. So let's take a look at a quick example. A corporation owns 100% of all stock in B corporation. For every calendar month, so A owns 100% of B. Basically, they are a parent subsidiary controlled group. B and C, sorry. So A owns 100% of all B and C. So A, B, and C are all members of a controlled group. So they have to look at all of their numbers of employees as a whole, as the group, to determine if the group is a large employer. A has 30, B has 60, C has 40. Combined together, A, B, and C have over 100 full-time employees. Therefore, A, B, and C are all considered applicable large employers. Therefore, they all have to offer that affordable minimum value, minimum essential coverage, or they will face a penalty. Being a member of a controlled group also impacts the penalty calculation. We'll touch on that shortly in a little bit when we talk about the penalty. But basically the point here is make sure you understand the ownership of your business. Understand if you are owned by another business, if you have partners in the business, if the same 5 or fewer owners own other businesses. You're going to want to double check and make sure you are not part of a controlled group, because that will impact your size for both the employer mandate purposes and also for the new IRS reporting purposes.
Quick question, Caitlin. Someone
Yeah.
asked if this is an example where a company has 50 employees who are in a union and are covered by the union health plan, and an additional 8 employees who are not part of the union and who are not offered coverage. Would the 8-employee group be considered separately from the 50-plus full-time covered group?
Nope. So when you calculate your size, you look at all of your employees. All of your employees, period. Whether they are part-time, full-time, union, seasonal. If they are your employees, they are added in to determine your size.
Okay.
Now
Go ahead.
The trick with the union is that there are additional rules that can help out union employers. If you contribute to the union plan and the employees get affordable coverage through the union, you've satisfied your requirements. But you do have to add in the union employees to determine your size.
Very good. Thank you.
Yep. So now that we've talked for a while about the size of employers, and I mean, that was a very good question, and it just reiterates you literally have to add in every single one of your employees. If they are your employee, they count towards your size. So now that we have talked about how to count your employees, how to figure out your size, we need to talk about what type of coverage you have to offer. The first requirement of the coverage you have to offer is that it has to be minimum essential coverage. Minimum essential coverage is not the same as minimum value. Minimum essential coverage is not the same as essential health benefits. These are all separate and distinct terms with different definitions. So just a little side note, essential health benefits are the benefits that qualified health plans through the exchange, they are the benefits they are required to cover. So in theory, minimum essential coverage does not need to cover all essential health benefits. They are two separate requirements. Also, minimum value does not mean the same thing as minimum essential coverage. We will talk about minimum value in a second here. Minimum essential coverage is a very easy requirement to meet. It basically includes any type of group health plan, group insurance offered by an employer to an employee, offered through the state in either the small or large group market. And so any type of employer-sponsored plan that offers basically major medical coverage, meets minimum essential coverage. This doesn't include things like FSAs, HRAs, EAPs, things like that. It's going to be like your major medical group health insurance. That can be self-insured, that can be fully insured, doesn't matter. As long as it's a major medical health insurance coverage, it is minimum essential coverage. You can just check that off the list. You're good to go. Now you have to make sure that your coverage meets minimum value. Minimum value is an estimate of the overall financial protections provided by the health plan. It will tell you the average share of medical funding the plan pays for a defined set of covered services using a standard population of both sick and healthy consumers. That is a sort of big, long definition that describes minimum value, and minimum value will provide a general summary view of what the plan will pay generally across a group of people. It is not a prediction of what each participant will pay for specific services. It is a statistical evaluation of the plan based on a standard population. It is not a prediction of what each person will pay. Now we went over that. You have to have a plan that has a 60% minimum value. Again, this is a statistical analysis. You have to have a certified actuary complete it. Usually, if you offer, major medical insurance through a large insurance carrier, they'll let you know they've done the statistical analysis, they've hired the actuary, they've done the work for you. You can also use the Department of Health and Human Services has a calculator that you can use to determine if your plan provides minimum value. There is no de minimis exception to the minimum value. So your minimum value has to be literally 60% or more. If your plan provides a minimum value of 59.8%, it does not meet this requirement. It has to be, there's no rounding up, it has to be 60% or more. And I make a big effort to say that because I worked with a group that had a minimum value of 58%. And we're like, oh, we're close enough, we just round it up. And no, you can't. You cannot round up on minimum value. It is a very literal requirement of 60% or more.
The good news is that the insurance carriers, if you have an insured plan, will calculate that for you and provide that sense of protection.
Right. And so that's nice for those of us that have the major medical through a major insurance carrier. One other thing to note, this is fairly recent, IRS Notice 2014-69. It came out in November of 2014. And basically the backstory here is that the Department of Health and Human Services came out with this calculator where you could calculate your own minimum value. And so it's this Excel spreadsheet where you typed in your minimum, you typed in the variety of services covered by your plan, the deductible, et cetera, and it gave you the minimum value. And some people were using this to build plans that did not look like traditional major medical insurance plans. And some people discovered that you could finagle the numbers enough and offer a plan that did not cover inpatient hospitalization or physician services, but would meet the minimum value requirement on this calculator. And so people started offering these plans saying they met minimum value, because technically they did. They met all of the requirements for minimum value. However, the IRS and the Department of Health and Human Services got wind of this and sort of, admitted to the loophole, saying, yep, we understand that technically that did provide minimum value, but that's not what we meant. And so they came out with IRS Notice 2014-69, and they said, we're going to come out with a rule in 2015. As soon as this rule is released, it's going to be effective immediately, and it's going to say that if your plan doesn't provide substantial coverage for inpatient hospitalization or physician services, it's not going to provide minimum value. The reason why this is important is because the rule is going to be effective immediately. And so some of these plans that were planning to get on the market that technically had provided minimum value will not provide minimum value in the middle of 2015 as soon as this rule is released. It has not been released yet, but we basically know what it's going to say. And so the departments wanted us to know that this was going to happen. They're going to release this rule. It was going to be effective immediately. So basically, get rid of these plans. At the same time, the IRS, Department of Health and Human Services, did know that these plans had been on the market, and some employers had been using them. Therefore, if you had a type of plan that technically does meet the minimum value requirement, but doesn't offer the inpatient hospitalization or physician services, if you had a binding written contract or you began enrolling employees before November 4th, 2014, and the plan year started before March 1, 2015, you can have the plan for the entire plan year. And so you get a little bit of a break if you meet those requirements. I don't know many employers that have these plans. I know a few. So just take note that if you do, you're going to want to double check these requirements. One other thing to note is that if you are using that transition relief, your employees may be eligible for a premium tax credit because they will be in a plan that at some point in 2015 will not offer minimum value. Therefore, they'll be able to get a premium tax credit. However, that will not trigger a penalty for the employer if they're using that special transition relief, were in a binding written contract, or began enrolling employees before November 4th, 2014, and the plan year started before March 1, 2015. So just something to keep in mind. If you happen to have one of those plans, I'd go back and double check when you enrolled employees, when you actually signed the contract, et cetera.
Yeah, certainly none of my clients have those types of plans.
Nope. Well, there you go. You can feel better about that. So let's chat about affordability, which does impact everyone, regardless of what type of plan you have. In 2015, the affordability percentage is 9.56, and basically coverage is affordable as long as the employee doesn't have to pay more than 9.56% of their household income for self-only coverage. So keep in mind that some employees may choose family coverage. Some employees may choose coverage for dependents. Some employees may choose a richer benefit plan, and they will pay more than that 9.56% for their coverage, but they just had to have the option to pick a self-only plan that was not more than 9.56 of their household income. I would talk about household income, knowing that no employer knows the household income for their employees. It is not a feasible thing to know. And so the IRS had said, yeah, we get that, we understand. And so they came up with 3 different safe harbors to use for an employer to determine the affordability of their plan. The W-2 safe harbor, the rate of pay safe harbor, and the federal poverty line safe harbor. So we'll talk about each one of those. Fun, interesting thing to note. So the definition of affordability, the true definition right now, the 9.56, will be indexed with inflation every year until it'll go up a little bit every year. Originally it was 9.5, this year's 9.56, and so it will continue to rise. If you are using one of the safe harbors, the safe harbor regulations hard-coded in 9.5%. They didn't keep in mind the fact that the technical definition of affordability is going to be indexed for inflation. And so if you are utilizing the safe harbor, you still use 9.5% because that was hard-coded into the rules and regulations. However, technically it's 9.56, but if you use, for example, the W-2 safe harbor, you use 9.5 until they revise those safe harbor regulations. This doesn't actually impact a whole lot of people because that 0.06% doesn't do a whole lot in terms of dollar value, but just keep in mind that if you're using one of the safe harbors, which I anticipate all of you are, you use actually 9.5% unless they actually go and change in the regulations and change that number to be indexed for inflation. So let's talk about the W-2 safe harbor. The W-2 safe harbor says that coverage will be affordable if the employee's contribution towards self-only coverage is not more than 9.5% of the employee's W-2 wages. The W-2 wages that we're talking about is the number that goes in box 1 on Form W-2, and that includes wages, bonuses, tips, basically all your compensation. It does not include non-taxable employee benefits like 401k contributions, 125 cafeteria plan, pre-tax deductions, etc. You have to determine the W-2 affordability based on that year's actual wages. So there's an example. So for an employee in 2015, their affordability will be based on their 2015 wages, which comes on the Form W-2 in 2016. So the problem with this, not necessarily a problem, but the challenge with this affordability safe harbor is that you can't necessarily know for sure your employee's W-2 wages ahead of time. You can say, yeah, we're going to pay him a salary of $50,000 until he goes on FMLA leave for 3 months. Well, now his W-2 wages is not the full $50,000 because maybe he wasn't paid while he was on FMLA leave. And so that's the major challenge with the affordability, this W-2 safe harbor. The easiest way to administer this is to deduct 9.5% from every participant's paycheck if they are enrolled in the self-only coverage. So obviously it's easy. You just deduct the 9.5%. Great, done. At the end of the day, you know they will never contribute more than 9.5% of their W-2 wages because that's literally all you took. The downside of this approach is that you may have different contributions per pay period, depending on how your employees earn their money. If they work hourly or if they are salaried, they may work more hours during one pay period versus another, therefore they will pay more during one pay period versus another. Additionally, different employees will have different contributions. Basically, your higher earners are going to pay more for the same coverage. That doesn't mean you can't do it, but it's just something that you should keep in mind. That's sort of the downside of that. The next safe harbor is the rate of pay safe harbor. This is helpful for if you have a lot of hourly employees. So basically, for your hourly employees, you take their hourly rate of pay, multiply that by 130 hours a month, and then you determine the 9.5% based on that number, their rate of pay times 130 hours a month. For salaried employees, you use it based on their monthly salary, and you just say, great, yep, here's what we anticipate you earning. If you work full-time for the month, you're paying 9.5% of that. Benefit on using this affordability safe harbor is that even if the employee goes on unpaid leave, they still have the same premium payments. And so in our example, the employee's on the FMLA leave for 3 months, but they still technically have the same rate of pay. They're just not working, but because you use the rate of pay safe harbor, they can continue to be required to make those same premium payments. Downside of this is you are not capitalizing on your employees who earn a lot of overtime, work maybe a lot more than 130 hours a month. Basically, you're leaving money on the table in terms of what the employee contribution could be. This is also not to be used for tipped employees or employees paid on a commission basis because their hourly rate of pay does not reflect what they actually earn. Last safe harbor, federal poverty line safe harbor. Basically, you base the 9.5% on the federal poverty line. Again, this is easy. It's simple. It's very, very easy to figure out. I figured it out for you. It's on the slide. That's what your employees can pay a month. Doesn't change throughout the year. The problem is you obviously leave a lot of money on the table in terms of what an employee can contribute to the plan. So we're going to breeze through a couple slides here. We're slowly running out of time. Basically, let's talk about what an offer of coverage is and who to offer it to. You have to offer coverage to your full-time employees, not your FTEs, just your true full-time employees, and you have to offer coverage to their dependents. An offer of coverage means the employee has to have the opportunity to elect or decline coverage. That opportunity is determined based on all relevant factors, facts, and circumstances. You have to offer coverage to dependents, which is an employee's child under the age of 26. This definition does not include spouses. You do not have to offer coverage to your full-time employee's spouse. You do not have to offer coverage to their domestic partners. This definition of dependent does not include foster children or stepchildren. And something nice to know also, a child is a dependent, the kid is a dependent for the entire calendar month during which he or she turns 26. And so it's not just the day they turn 26, they're kicked off the plan, they get coverage for the rest of that month too. So what are the penalties? There are two types of penalties, penalty A and penalty B. Neither penalty gets triggered or gets assessed against an employer unless a full-time employee gets a premium tax credit. Again, not an FTE, we're talking about true full-time employee. That is why the King versus Burwell case we talked about at the beginning is important, because if in the majority of the states in the country that are on the federal exchange, no one can get a premium tax credit, no one can trigger a penalty for the employers in that state. Penalty A is the penalty that you get assessed if you do not offer coverage. Your penalty, your monthly penalty, is going to be your number of full-time employees minus 30 times 2,000 divided by 12. So you only count your full-time employees, not your FTEs. Again, only applies if at least one full-time employee receives a premium tax credit. There is a transition relief for 2015 that employee reduction is 80 and not 30. And so that's a nice little break for those employers who are not offering coverage in 2015. One thing to note, the penalty is based on all full-time employees, even if you offer coverage to some. So in general, an employer is treated as offering coverage to all full-time employees if you offer coverage to 95% of them. In 2015, you only have to offer coverage to 70% of your full-time employees to avoid this penalty. But say you do the math wrong and you offer coverage to 50% of your full-time employees. Well, you triggered the penalty and you're going to be penalized based on all your full-time employees. IRS does not care that you offered coverage to 50% of them. You are going to be penalized based on all your full-time employees. So do not calculate your number of full-time employees incorrectly, and make sure you offer coverage to at least 70%. I would say make sure you leave as much wiggle room there as you can, because you don't want to get below 70%, because now you're offering coverage, you're paying for coverage, and you're paying a penalty. So here's a little chart, fictional chart I came up with that sort of shows how your penalty can fluctuate depending on how many full-time employees you have. Think of this employer that has a busy summer season, and so they hire a bunch more full-time employees, they don't offer coverage to anyone, and so their penalty really fluctuates based on how many people actually work that full-time 130 hours a month, and that also impacts their penalty for each month. I'm going to go ahead and skip over, because we're running out of time, the controlled group penalties. Feel free to read these slides, especially if you are part of a controlled group, or shoot me an email if you want a little bit more detailed information about the controlled group penalty if you are a member of a controlled group. I want to jump right ahead to the second penalty. This is the penalty that you get assessed if you offer unacceptable coverage. Basically, if you offer coverage that is not minimum value. This is why that IRS notice about the physician services and the hospitalization is important, because if you happen to have a plan that did not offer minimum value, or all of a sudden doesn't offer minimum value in the middle of 2015, you will be assessed this penalty. Also, this penalty applies if you do not offer affordable coverage. The penalty is $3,000 divided by 12 times the number of full-time employees who actually receive a premium tax credit. And so it doesn't matter if you offer unaffordable coverage if no one gets a premium tax credit. Great, you're in the clear. The problem is knowing who's going to get a premium tax credit can be kind of hard. It's not impossible, but it is a little bit hard to determine who's going to be or which of your employees are going to be eligible for a premium tax credit. This premium tax credit is basically, it's a sliding scale tax credit to help make coverage more affordable. And so the amount of the tax credit is based on the benchmark plan in your state, plus the taxpayer's expected contribution to the plan based on a mathematical formula. In order to be eligible for a premium tax credit, and you want to know this because maybe you will know if your employees are eligible or are not eligible for a premium tax credit. If none of your employees are eligible for a premium tax credit, no one can trigger a penalty. So keep that in mind. In order to get a premium tax credit, you have to be an applicable taxpayer. If you're married, you have to file your taxes jointly. If you are a dependent through the tax code, not the definition of the dependent for health care insurance purposes, not that 26 age, but definition of dependent under the tax code, you're not an applicable taxpayer. You have to have a household income between 100% and 400% of the federal poverty line. You can see the little chart I put in there of the federal poverty line guidelines. This is based on the number of people in your household. And so that's why it's really hard to accurately estimate if your employees will be eligible or not, because you can't just base it on, oh, well, great, I pay my employees, I pay everyone $100,000 in a year. No one is going to be eligible for a premium tax credit. Well, if someone has a very large family, it is very possible that they might be eligible for a premium tax credit. And so just keep that in mind. You can't just bank on the person being a single person or having, additional income, things like that. So just keep that in mind. You also, in order to get a premium tax credit, can't be eligible for other minimum essential coverage. So people who are eligible for Medicare, Medicaid, CHIP, TRICARE, or affordable minimum value employer-sponsored coverage are all eligible for minimum essential coverage. Therefore, they cannot get a premium tax credit. You also have to get your coverage through the state exchange. And so that is how who is eligible for a premium tax credit. It is not impossible to estimate who or which of your employees are eligible for a premium tax credit. It is hard. I wouldn't necessarily rely on that, but it's nice to know, to have an idea of maybe who would go get a premium tax credit. If you have, a lot of lower income earners that will probably be eligible, you're going to want to be very careful in who you offer coverage to and the affordability of your coverage, because you don't want them getting a premium tax credit and triggering a penalty for you. We are definitely approaching the end of our time here. I do want to make sure you are aware of a few other ACA rules and regulations. There's the waiting period limitation, can't be more than 90 days, plus the bona fide orientation period. There are brand new wellness plan rules that came out within the last maybe 2 months. So if you have a wellness plan, you're going to want to take a look at that. There are, additional fees, especially for self-insured coverage. There are new regulations on plan designs. You can't pay pre-tax for individual health insurance plans. You can't let your employees pay for those individual plans pre-tax. There are some non-discrimination testing requirements, so just keep that in mind. We do not cover, obviously, everything that employers are required to do that is new in the Affordable Care Act. We focused on employer size today, what types of coverage to offer, and a very basic overview of who to offer coverage to, the penalties you could be assessed. We will talk about during the next webinar using the look-back measurement method. And so if that's something that you are thinking of doing or you are doing, I would definitely attend that webinar on June 10th, June 24th. Anyone who is close to that 50 mark of full-time plus full-time employee equivalents, I would attend that June 24th webinar. We will talk about the new IRS reporting requirements. We'll take a look at the forms. We'll talk about what information you need to collect and everything you need to know about those new requirements for reporting to the IRS. With that being said, thank you very much for attending today. I apologize for going over a couple minutes here. We had a lot of information to cover. We will send out a copy of the PowerPoint slides here, and other than that, you have my contact information. You have Kelly's contact information. Thank you very much for attending, and have a wonderful afternoon.
Thank you. Thank you, Caitlin, for doing that. So everyone, if you're on the phone still and you can hear me, I will be sending out the slides, but I also have a spreadsheet to help you calculate your ALE status. And then we also stand by ready to assist in any of these areas that deals with healthcare compliance. So thank you for your time, and I look forward to talking to you soon.